1 o'clock officially rolls around. And there it is. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their representative officers, personnel, representatives, agents, or independent contractors are in such capacities. Licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in this webinar website or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone. Fantastic. All right. How is everybody doing today? The Dow is down again. We're having some excitement. I mean, all the indexes are down for that matter. What are we looking at here? Oh, oil. I forgot all about oil. You know, it's funny, it had that spike down to 1030, then spike back up after, and now it's back where it started. We'll take a look at oil. That's a good way to start. But meanwhile, everything's down. The Dow's down 0.7. The S&P's down 0.7. We'll get back to the NASDAQ over here. And Q down 0.7, but the Russell is down 1.5. So the Russell's down twice as much as the other indexes. That's not a good sign. It's kind of, it's that the Russell is that fast moving tugboat that goes a little bit further out than the other ones, but the other ones often go the same way the Russell goes eventually. So that's not good. Below 1550 is not good. Below 1500 is going to be terrible. So watch out for those lines. But we already knew that when the S&P failed at 2800 again. That was a bad sign already. So none of this is really surprising. What are we going to look at? Oil, right? We love looking at oil. What is this? This is a survey. We don't care about that. Petroleum. I did not even look at what the oil report was today. I heard there was a bill, but frankly didn't care because if we aren't playing it, I don't care. We were playing kind of bullish for oil. Wait. Week ending February 22nd, that can't be right. That doesn't sound like the right report, does it, guys? No, it should have been the 27th. This is the old report. I guess we're gonna have to wait. All right, meanwhile, let's go to Seeking Alpha and see what they have to say as far as what the numbers were. Get the question box out of the way. News by date. Now we go down to 10:30. Oh yeah, the Fed's coming out with their Beige Book later. That's going to be interesting at least. Then we got something to read. Facts. I love facts. Facts make me very happy. All right. So oil's up 7. All right, so last week we had a big draw, and this week we have a big build. So it all evens out. I think I said last week, I said you can't go by what 1 week is. You have to see if there's a trend. So this is completely reverse the trend. There's no trend. We're still using gasoline though, but that's because we're shipping it out. We talked about that. So net though this week is, remember net last week we had a nice draw here and a draw here and a draw here. So last week was a serious draw. This week the build here cancels these guys out pretty much exactly. So it's net flat. So there's no change. We converted some oil We have inventories, right? This is all inventory. We converted some of the oil in our inventory to gasoline and distillates. All we did was change one thing to another. It's alchemy. That's not use. There's no net use. We didn't draw down any net oil from the reserves. We just changed the oil into other things. And that is really what most traders don't understand about oil trading is they see these numbers and they think it's there. Like this build number, whoops. Week ending March 1st, where did that come from all of a sudden? Oh, that was the summary this morning. Now we're still trying to get this one. Because I clicked on Seeking Alpha accidentally. Still February 22nd. Really? Nope, now it's fixed. Okay. I have to refresh the thing. All right. So the week ending March 1st, blah, 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 $7 million. All right, whatever. So what happened? The input to refine is about the same. The refinery utilization about the same, and that's going down a little bit. They're actually refining a bit less than they were. Gasoline production, I mean, look dead the same. No change at all. Distillate fuel production, the same. It's just really is random stuff. Now, this is interesting. Oil, excluding in the SPR, was a build. Gasoline, a small draw, we know that. Distillate there. All other oils is down 1 million, and the SPR is flat. So really not much going on at all. Look at the exports though. We are now exporting this week. We're exporting 3 million barrels a day. We went from 26 to 27 to 27 and a half, so up 1.5, and now we've gone up another 1.5. Actually, 2. We've gone up. So we're going up 1.5 million. No, I'm sorry, not 1.5. 150,000 here, and now we went up 200,000. So in 3 weeks. We've gone, well, that's confusing. Why does that say 3/2/18? Oh, that's a year. Sorry, forget that. No, that's from last year. Anyway, so still, this number here is 300,000, is 10% higher than last week. Understand that's 300,000 barrels per day more oil this week being shipped out of the country. Not oil, really, gasoline. That's the key to this, right? So 2.1 million barrels. 7 days, 300,000 barrels, 2.1 million barrels of gasoline and some distillate, whatever, other stuff, got shipped out of the country. So we're refining stuff, but we sent 21 million total barrels out of the country, or more like 22 million total barrels were shipped out of the country this week. So the fact that we still have a net zero change in inventory shows what a tremendous glut we have. God forbid we weren't shipping this stuff out, what would happen? We would drown in oil. What on earth would we do with 22 million barrels piling up every single week? At the end of the year, we'd have 1 billion more barrels. That's more than we have. That's half our total reserves in the country. That's the rate we're building up. Half our total reserves are being built up and we're shipping them out of the country. There is no shortage of oil whatsoever. The Saudis have cut their production. What that means now, they're cutting production. It means their capacity is higher than their production. So we have way more oil than we need. The Saudis obviously have way more oil than they need, and even when they cut production, there's still a global glut of oil. So there's these oil prices. I mean, other than the normal bullshit where they're going to run it up into the summer, there's nothing supportive of oil. I hope oil goes to 80 so that we can short the crap out of it, after the summer. I'll be surprised if they can make 70 the way things are looking, though. There's really nothing very supportive, no matter how much OPEC cuts. In fact, earlier this week, I remember writing yesterday, there's a couple of articles. Here we go. Home. Nope, that's the wrong thing. Was it yesterday? I lose track. Today was Tuesday. Oh, I'm so good. So look, Chevron ramps up their Permian Basin to 900,000 barrels a day. Exxon ramps up their thing to 1 million barrels a day. So there's 2 million barrels a day more oil coming on the market from the Permian Basin, just from this one place, from the Permian Basin, from just 2 companies. Don't think everybody else isn't also increasing their outputs and doing what they can. All right, everybody's trying to drill the crap out of this place before like Democrats come back in power and go, stop destroying the environment, please. You know, there's no way anybody in the Trump administration is going to tell them that. So so while they can, they're fracking, they're causing earthquakes, they're destroying groundwater. They don't give a shit, and they will get as much oil as they possibly can out of this thing. So the target is 5 times as much as Exxon now produces in the Permian Basin. For Chevron, it's 40% from their previous forecast, but it doesn't say how much they actually do now. But they're also projecting $60 barrel oil, which is not necessarily going to happen either. So we'll see this is very interesting. And Cheniere, we talked about LNG, they're going to export. This is another thing. Our natural gas, we're exporting the crap out of natural gas to China. $18 billion worth of natural gas is going to China. So we're shipping out, at this point, we're already sending out almost 1/3 of our total production is going out of the country, and we're still full of natural gas. We still have plenty of natural gas. We are swimming in natural gas. We are swimming in oil. It is insane that any of these commodity prices are going up at all. But, you know, they're going to be manipulated up. This is a prime time for manipulation bullish. Between now and July 4th, really, but into Memorial Day is the key, or Labor Day, or whatever day it is in May. There's going to be a lot of push to get the oil prices as high as possible, and but then after that, they're going to lose all their catalysts, and we'll keep an eye on it, but it's going to be ugly, I think. Anyway, so what do we get to? We're exporting, again, always keep this in mind. We export 21 million barrels a week of oil. That is insane. It used to be a law you weren't allowed to do this, and we would have had we'd have right now $40 oil, $30 oil right now if it wasn't for this. But now, you know, we're sending all of our glut out of the country. So we got gasoline, flat. I mean, you see, don't see any real changes to the numbers. Product supply. Now, see what happened with distillate? That fell off a bit. So there's a reason that might come down. But gasoline was the same, but we just shipped it all out of the country. That's where that came from. And that's that. And the prices came down a bit last year. See, here's 18. We were $62 last year, $61. Now we're at 56, barely holding 56. That's nasty for the oil industry. And gasoline, oddly enough, was 176, and now it's 177. Even though the stuff that they make gasoline out of got cheaper, but somehow gasoline prices are maintained really high. Why though? Because we're shipping 3 million barrels out of the country. There's a reason for that. And that's a funny thing, because when Trump, and then when they have a policy, we don't eat soybeans, so we don't care. But when they have policies that we ship out soybeans and we ship out this, and we've got to sell this overseas, you can say, again, things that they say are great for America are great for the guy who owns the oil well and great for the guy who owns the soybean farm. And I know they love to portray the farmers as the little guys and blah, 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 but there's not that many of those guys. Most farms are gigantic factories that are owned by a very, very few, very, very wealthy people, and they produce megatons of crops and ship them overseas. Yeah, there are plenty of small farmers there, but you can get 50,000 of those farmers together. They don't equal one large factory farm. You know, and so there's a lot of little farmers in Iowa and places like that, and they like to think that they're doing some major thing. But if you look at the numbers of what they produce versus what's being actually produced in the country, it's insignificant. But the joke is that they run on a platform and they say they're doing this for the farmers, and they trot out these farmers who go, oh my, because what do they know? Their whole life is a freaking farm. Their whole life is their farm. They know their farm. And they'll tell you all their heartfelt stories about how tough it is on their farm and blah, 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 and how this and that and the price of this and that and whatever. And you feel bad for them. You want them to get a fair price for their crops. But meanwhile, you go to the store and when you buy, when I go to a Japanese place and I buy edamame soybeans, it's way expensive. And when and artificially so because we ship them all to China. We are the world's largest producer of soybeans. We don't even eat them. Americans don't eat soybeans. Everyone else eats soybeans. Soybeans are great, but it's a great crop. But unfortunately, Americans never really acquired a taste for it. There's not much food that we do that has soybeans in it. We ship almost all of our soybeans out of the country. We ship a ton of our corn syrup and corn out of the country. And oil now we're shipping out of the country. What does that do? It artificially inflates the price. So the success of the farmer and the success of the oil company making all this money is a tax on you because you're paying way more at the pump than you should be. Okay, oil fell $6, so 10%. So oil fell 10%. Gasoline went up. Gasoline should be 10% cheaper. You spend on an average, you spend about $1,500 per car on gasoline in a year. And that means that you spend $150 to support the oil industry so this drill baby drill, send it all out of the country, export as much as you want, free the markets, send more oil to China, make them buy stuff, cost you $150 per car. So, for however many cars you pay for out of your pocket. You are the one feeding your money to the oil companies by paying them a higher price. They love it. Same with natural gas. Natural gas was almost free for a while in this country, and now we're shipping it all out, so we're starting to pay higher and higher rates for natural gas. I mean, look, it's great for us. We offset it by playing the options and things like that, or the futures on these contracts. But you gotta, look at the bigger picture. It's not necessarily great for the country to export your commodities. Exporting finished goods is different because there's jobs and people work on them at various levels. So in other words, if you export Lego, let's say, first you make the oil, then the Lego company buys the oil in America from American companies, converts the oil into plastic, right? That's a process. There's a factory that does that. And then the plastic is then goes to the Lego factory. So there's trucks and people are employed, and it goes to the plastic factory and the Lego factory. They make the molds and then they pack it up and they ship it, blah, blah, blah. And then you buy your Legos. Okay, or we ship it out of the country and then somebody else buys Legos and pays for all that work that was done in America. That's all great. Okay, but when we take oil and we ship it out of the country, there's only one person that makes money. Well, the shipping company makes money. The guy who owns the oil, who gets it out of the ground, puts it on a boat, and sends it out of the country and collects the foreign money for it. No Americans benefit from that, and all the Americans pay for that out of their pockets for higher prices. That's how things work. And it's a complete, it just amazes me when politicians talk that they count on the fact that nobody understands how it works. All this bullshit they talk about is based on the fact that they assume you're completely ignorant of the process. Really pisses me off. Anyway, and that's what I got to say about that. All right, nobody has any questions, so I guess either everybody's stunned or getting through or whatever. All right, what else? Oil. I feel like I had something else I want to say. Let's take a look at the futures while we're here. You know what the futures? You're the futures. Well, first of all, I said this is what we call a spinning cobra pattern, and a spinning cobra pattern, you can see it on a shorter term actually. Nope, doesn't look like that. No, I guess The dailies. Oh, here you go. This. So a spinning cobra is like when a cobra coils up and it raises its head and it's ready to strike. So where does it strike though? There's physics to this thing. The length of the body. If he strikes forward, his body doesn't get longer, so therefore he goes down when he strikes. You can't strike across unless he picks his whole body off the ground to make a strike, which is difficult. Anyway, but that's how cobras work. That's not necessarily how the market works. But the bottom line is that's why I call it a spinning cobra pattern, though, because usually when you see this kind of thing and it starts making a little head like that, and it looks like it's resting up here, it's very likely to go down, especially when you start coming into the resistance like the 200-day moving averages, which are there. No, yes, no, yeah, in today's post. Because Jean-Luc very nicely provides us with the chart, so we have to go find it. Oh, look, it's right there. All right, so we're at these highs, but a couple of them, like the NASDAQ and the NYSE and the Russell, are barely getting up to their 200-day moving averages, and they're having trouble there. And if they go down, we can expect to see them hit these 50-day moving averages at some point. Now, depends how long it takes. The 50 days are moving up pretty rapidly. We had a huge recovery, caused the 50 days to come up nicely. They curved up fast. So they're going to make a bullish cross, not a death cross. They're going to make a bullish cross at some point. So here's what a manipulator is going to say. He's going to say, well, look, if I can keep the index up over the 50-day, up over the 200, or at least over the 50-day moving average until it crosses the 200-day moving average, we'll be in good shape, because then you're going to get this very bullish signal that a lot of people are going to follow. So at the rate we're rising, here's February, here's March. So we can extrapolate that if we stay this high, we'll be up the next dots in April, and by May we should hit 7,000. So as long as we stay up here, we'll make a bullish cross in by early June of the indexes, and we'll be in good shape. Now, you see, the more important thing, if you're going to look at charts, don't look backwards. Think about how these lines get drawn. And it's not a mystery, and it's not random. I mean, the candles and whatever are random, where the price is any given day. But these lines, it takes 200 days average of where these are to make this line move. So it has to be pretty high above it to get it to move up. It takes 50 days to move this line. So every day you're above, 1/50th of the difference between here and here is how much this will move up today. Get it? So in other words, if this were 50 times higher than here, it would move up significantly every day. If it's only, well, I can tell you exactly, it's 400 points higher. Divide that by 50, that means this number here is going to be, all right, that's the best way to explain it, I think. See, I just figured out how to explain it. Here's your 50-day moving average, here's where we are. Okay, so if today we're 400 points above the 50-day moving average, then tomorrow the 50-day moving average will be 400 divided by 50 higher. It'll be 8 points higher. So it'll be 67, roughly 67.52 tomorrow, plus or minus a point, assuming we close it around where we are now. So you know where the 50 days, this is what I mean by looking forward. You know, it's a mathematical fact. You know, if we stay here, then this is going to go up this much per day. And so if it's going to go up 8 points a day from here, that means to get to 6,900 is 150 points, let's say. Divide, I'll call it 160. So 160, divide that by obviously 8 is going to be 20 market trading days until we get to 6,900 for our moving average on the NASDAQ. Okay, so it's going to take 20 trading days, which is basically the entire month of March. And then just what I said, except that now I'm doing it where you can see the math. And then because I do it in my head and then I don't remember how I did. You know, I don't really think about how I'm doing it because it's sort of intuitive to me because I've been doing it for so long. But this is what I mean by thinking ahead, because you say, well, what's it going to take for this to happen? And that means what's the likelihood in the next 60 days that this pattern will fail? So then we take into account what's the news. Well, again, we're likely to get a proper China deal. That seems pretty likely right now. Brexit keeps getting pushed back, so I don't think that's going to really collapse or cause a calamity. Trump, I think people are going to be sick of the Trump stuff, but, you know, I think they're already sick of the Trump stuff, but I think, you know, you have the big Michael Cohen testimony. The next thing that's going to happen is Comey's going to have his report. They're going to fight over whether it gets released or not, but somebody's going to leak it no matter what, so it doesn't matter. But then it's not going to be conclusive because it can't be conclusive. It's an investigation. All it does is say this requires, you know, we recommend a full investigation of this, we recommend a full investigation of that. The Comey thing is not a full investigation, not Comey, Mueller. The Mueller thing is not a full investigation. Okay, he's gathering evidence and he releases his report of the evidence he's gathered to Congress, who then take further action. Trump had been hoping that he would have a Republican Congress when this happened and that they would say this requires no action whatsoever. And of course, you hear the senators already saying, and the Republicans in the House saying, oh, this is nothing, there's no proof, there's no smoking gun, blah, 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 so we don't need to go any further with that. You know, that's what they're looking at. Even though obviously with Benghazi, there was never a smoking gun, there was never anything there, and they kept going for 3 years. So the same people now see not enough evidence to even bother looking into Trump. So anyway, so the point is, you look for what's going to hurt the market. Earnings, there's no earnings for the next 2 months. We're done with earnings. We got through it. It's okay. So there's not really any major bad news catalysts. China's got some problems, but it's going to be a month before we just got a bunch of bad reports out of China. We just got a downgrade of the global economy. There are several things to be concerned about that might take us back down to the 200-day moving averages, which are actually, I mean, it's a pretty big drop at this point because you're like, that's 700 Dow points lower just to get back to the 200-day moving average. But 700 Dow points lower, it took the Dow from 26,000 to 25,800. So the Dow only dropped a couple of hundred points in the last 2 weeks. So at that rate, by the time the Dow hits the 200-day moving average, the 50-day moving average will be just about ready to come across it, and it can bounce right up and take off. So we're looking for, so in other words, we're going to be looking for a small pullback, not a huge pullback. And that's why we haven't gone crazy with the hedges, because it's very hard to break through when the 50-day moving average is moving up. Certainly, by the time you hit the 50-day moving average, that's going to be very supportive because it's coming right up into the downtrending market. And also, more math, by the time, where's my calculator? Okay. So for the NASDAQ, 7,200, right? So 7,200 times 0.975. So what happened? 7,200 times point, the number lock, 0.975. So a 2.5% drop on the NASDAQ takes you down to 7,020. Right there. So you know you're going to have some support at 7,020. And you've already got the 20-day moving average crossing over the 200. That's going to be supportive. So it's going to be hard for the NASDAQ to move down more than 2.5%, unless, of course, something happens to Apple. Then 7,200 times 0.95 is 6,840, right there. Now, so there's almost no way the NASDAQ is going to correct more than 5%. Now, again, without Apple having something bad happen to it. So, and I don't foresee that. So since I don't foresee that, I don't see the NASDAQ really correcting much more than 6,800 down here. The 50 days moving up, it'll be at the, so in other words, the 2.5% line, the 2.5% drop, and the 50-day moving average will match going to be super hard for the NASDAQ to go below that without a massive bounce. And since the bounce will take you back to the almost to the 2.5% drop, honestly, you don't have to worry about much below 77,000. Because even if you fall below it, it's probably going to bounce back to that line at least. So which means that it would be foolish to play for a major correction right now, since it's very unlikely to happen. I did say this morning I'd like to see one. We're not going to see one. I'd like to see it. It'd be nice and healthy to have a good correction. It would be fantastic if we could correct back to these lows down here and consolidate a bit and then move up. It'd be way healthier. But that's probably not going to happen. You got the ECB is still being easy with the money because, of course, the ECB is run by Goldman Sachs. You know, Carney's a Goldman Sachs guy, and Draghi's a Goldman Sachs guy. So they're never going to let off on the gas at the moment. You know, over in Europe. Plus, they're terrified of the repercussions of Brexit, so they also don't want to let off on the gas because they don't know if it's all going to fall apart. China, of course, obviously stimulating the crap out of the economy. Australia needs to stimulate their economy. Canada is still stimulating their economy. Japan's stimulation crazy. Nobody's letting up on this stuff. So while I don't think we really have enough good news and whatever, and also that's the problem though, they've already been stimulating the hell out of the economy. So a little more stimulus doesn't cut it. It's not enough. China just put I think like basically about $500 billion China just threw into the economy. And they only have a $10 trillion economy. So they just put 5% of their entire GDP into stimulus. That would be like us announcing a $1 trillion stimulus package. So everybody's still pushing very hard to keep the markets up and keep the economy moving and so on and so forth. I just talked about that. Was that today? I talked about the Chinese building. Was that today or yesterday? I remember talking about it, I just don't remember when. That was yesterday, but that's very important stuff. China's biggest property developer is massively leveraged, massively in debt. They're gonna blow up. All of those people are gonna blow up, and it's eventually gonna collapse. And China's just basically desperately trying to stave it off as far as they can. I think the central banks in the world have one more bailout in them, that they can go and do stuff and push stimulus and whatever. I think they can do it for one more shot to keep the economy moving. But after that, it's just gonna be out of control. It's already out of control. We have $22 trillion in debt, not counting the $5 trillion in debt the central bank ran up. That's government debt. That's not private debt. Private companies also have record amounts of debt. I'm not sure how much it is in America, but it's probably, I'm going to say $10 trillion in private debt on top of that. In China, it's the opposite. In China, the government only has $10 trillion in debt, and private enterprise has $20 trillion in debt, which is 200% of their GDP is by businesses have that in debt. That's horrifying. So the bottom line is the government can't afford it to bail them out. It's not possible. And so when it actually starts happening, run for the hills. But meanwhile, we can enjoy ourselves. So meanwhile, though, it looks like we got pretty smooth sailing into, well, I mean, look what we're saying. We're saying that we're not going to go down significantly between now and June. Wait, no, between now and, March, April, May. So into May, we should be holding up pretty well. We have the positive cross in May, and then there's a catalyst to take us even higher over the summer. So it will not be a sell in May situation probably. So unless anything really bad happens, unless the first quarter reports turn out to be complete crap, which is possible because of the shutdown and all that. And that's why the Beige Book's important. Oh, when's the Beige Book? Very soon. So unless the beige book indicates that we got way worse problems than we think, I think a lot of the stuff's going to get shaken off, and we're just going to just keep drifting along up near the top. But I don't think it's a top that's deserved, so it's going to be hard to go much higher too. ALK, okay, so Todd says ALK hit overblown. I didn't see the ALK went down, so I'm going to take a look. But yes, if they're down because of Southwest flying to Hawaii, that is just silly. Oh, well, of course it hit because Southwest offered like $49 fares. They always do that, though, when they're going into a market to piss off their competitors. So obviously, yes, there will be a certain amount of business just ripped away from ALK. Oh, that sucks. Yeah, because we're long on ALK somewhere. Where is that? Do we ever? I forgot what position we have on that. Portfolios. Short-term portfolio. That's crazy. 636. Long-term portfolio. Yeah, it's a good time to probably start a position in ALK. So let's see. This is ALK. Yeah, there you go. See, we're not a big position. Actually, you know what? This is we're basically back to where we started. This is where we came in with these guys. I'm certainly going to be inclined to buy these back. So yeah, I think overdone. I think the move is going to be that we're going to buy back these the 20/20/70 calls because we're up almost we're up 75% on those, and we have to wait another year to collect. And meanwhile, if we're going to resell, it'll be a good time to take advantage to roll these 45s back to 2021. The $60 puts I wouldn't change. So I'm not going to pay them $8. It's all premium. So I would roll these out to 2021. We'll figure out a strike. I'll buy these back, and we'll wait and see what happens. But yeah, I mean, obviously, if Southwest comes into the market, I should have thought of that as frankly, that was silly. I read it, and they do it all the time, but I didn't think about how it would affect ALK, which was silly of me. They put these incredibly ridiculous fares down, and obviously it's going to rip the business away from whoever's in the area. Anybody who's actually servicing those flights is going to get killed, and then it goes back to normal. As soon as Southwest fills their planes up, then it goes back to normal. That's all. You know, but they're hitting all the airlines, I'm sure, with that stuff. So let's see. UAL. Huh, not bad. Delta. DAL. None of those guys, not getting hit like ALK. So I think it's an overreaction. I'm going to look more into it though, but it seems a bit silly to me, and I didn't think their earnings were bad or anything. So I'm not quite sure why they're getting hit so hard. Let's see if it says anything here. Frontiers. Why are we looking at Frontier? Oh, the news on Yahoo gets stuck. It's stuck on whatever you looked at last. Airline stocks bumpy ride. So they gave everyone a hit. Alaska Air fell 3% after they cut their revenue outlook. When was that? That was 6 hours ago. No wonder. Delta. Alaska chopped Hawaii fares after Southwest did it. Yep, that's what's hitting them right now, that kind of stuff. Yeah, I wish I could hop on a plane and go to Hawaii. That'd be nice. It's like $49 one way. That's crazy. I love it. All right, so back to the market. Where were we? Oh, so here's what's happening here. Look, everybody's curving up a little bit. Maybe something good's going to happen. This is actually a good spot. Well, let's do that. Let's see what happens. Give me a little bump into the Fed. Take a long, and I missed it. It's going up fast. Let's try it again. Oh, I got that one. All right, so let's get rid of that. All right, so 1541.80 Just taking a little quick long. I see, look, you see everybody's heading up and he's a little slow off the gate. So of course you pick up the guy who's slow and see if they keep going. If it stops, if they stop going, then we get out. It's not complicated. And now see, and now you start looking at goals. He's like miles below the green line here. These guys, he's above, he bounced off the green line, he didn't hit the green line, and he fell below, and he's coming back. So if he's back over now, and he's coming back over, if he comes over also, it's a great sign that we will probably retrace almost half this distance, so probably at least 1550. You know, but for futures trade, we're up a quick $100 already. And so now you want to just like lock it in. It's a quick little trade. It's a nice thing. It's nice to make $100 in 5 seconds, right? So let's say if it goes here, oh man, I'm gonna fall below it. I was gonna say if it goes there, I want to get out. 80? Come on, man, you're killing me. Nope. All right. Oh, I can't sell it now. Oh. That wasn't fair. Do we want to take that little? Yeah, I should have. All right, screw it, because I don't want to watch it. There, got that. All right. Now we erase that. All right, so $40. Good. See, when you make a quick, like I was saying, when you make a quick $100, you got it. It doesn't matter what you think or what you wish or what you hope. Take it. We had a $100 gain in 10 seconds while we were doing it. It's like that. If you make $100 every 10 seconds, you're Bill Gates. So it's not like he probably makes 1,000 every 10 seconds. But in any case, when you make money that fast, just off a stupid little thing like it happened to be looking, I saw everybody going up and the Russell wasn't. You take that and run. Because I don't know why it went up. I don't know what exactly happened. And like I said, I want to see these guys clearing these levels so that I feel more confident. They've started stalling, and he started going back. So that was that. Now, where did we come in? I forgot. Did we come in at 41.80? 30? I forgot where we came in. It must have been 40.8 or 41.8. This can't be where we came in, was it? Yeah, maybe it was. All right, so I think we came in around 41.8. So now we're back to where we came in. And we still want to watch and see if these guys, are they making progress or are they not making progress? All right, so maybe, hopefully the Russell just had a bit of a rejection. It's going to get on its way back on its legs. There's nothing magical about this spot though. This is just where we happen to finally get in. Remember, I was trying to get in here closer to 40, didn't make it. Went up, see, it started zooming up off that 40 line real fast. So I don't have a compelling reason to get in because he can't get over this line and he can't get over this line, 75. So if he can't get over 75, there's no point in trying to play this one bullish. I want to see the Russell over, I want to see the S&P over 75. So he's at 75 now. So he's at 75, he's 71.25, but that line is more like 28, so that's not that encouraging. You want to see at least one of these guys pull a breakout that looks exciting. And again, this is unfortunately the boring part of futures trading. Is if you see a setup and you watch it, you just gotta watch it for a while. You can't jump in and keep pressing the button. You gotta have a pretty good handle on what's actually happening. All right, so there's unfortunately nothing clear. Sorry, it was very fast, but there's nothing that clear here. So we don't know now. Meanwhile, I'll take a break. I'll look at the news. I'll say, what happened? Nothing. There's nothing particularly happened here. Certainly not the CP Alpha reported anyway. Technology movers and shakers. Nobody cares. Nobody cares. Nobody cares. Okay. Alibaba, shorts burned by trade optimism. Oh my God. Yeah. Did we do them about the play? I thought we did something about them. Logitech, Microcaps, dominate midday movers, big deal, blah, blah. Nothing. There's nothing here. Oh, here, this is an interesting thing. All the biotechs, everybody who's got stuff in the pipeline is trying to get approvals because the FDA commissioner quit. And that's going to delay everything of the agencies. Everything's going to get all held up. People are going to miss their deadlines. Investors are going to get pissed off. It's going to be real bad. It does matter what these people do because without them, you can't approve anything. And, the agency will still function, but it's going to be definitely slow processes down. And then you don't know who the new person is going to be. Oh, William said something, but that was 1240. Nah, didn't have much of an effect, did he? So what did William say? The new normal well, he didn't say anything anybody wanted to hear. He sees U.S. GDP growth slowing to 2% this year, down from 3%. Moderation isn't necessarily a cause for alarm, but a new normal. That new normal is going to that new normal completely destroys Trump's entire budget. They projected 3 to 4% GDP growth to offset the idiotic tax cuts. From the perspective of monetary policy, you have very low unemployment, sustainable growth, and inflation at 2% goal. Blah, blah, blah. There are risks to consider, such as geopolitical uncertainty. And they'll consider the data, blah, blah, blah. And Powell already noted the elevated global uncertainty. I noted the global uncertainty. So there's a lot of global uncertainty we're all worried about. All us big-time economists. Motorola, blah, 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 blah. Oh, Miss Howe, we just talked about how we like those guys. Reaches a railway deal to resume production, so on. Okay. China Automotive, CBS Health, Dean Foods. Wow, Dean Foods got killed. That's not good. Yeah. Things like Dean Foods bother me because it's not like people are really choosing them or not. It's just they're just everywhere, and it just means people are cutting back on consumption, basically. Micron taking a hit. Wow. Very sad. And oil, as we said, went the wrong way before going the right way. Well, it didn't go anywhere, really. I mean, it went all over the place and came up and down. All right, so nothing strong, and certainly what William said isn't something I want to be bullish about, so we're going to leave it and wait for the Beige Book and see what the Beige Book does, if there's anything important happening there. Oil still drifting along, gasoline. Let's see how gasoline's still getting pushed higher, even though oil's there. Natural gas had a bad day, but might be if you like getting in and out, it's fun to get back in and try it again. Gold, silver getting closer to that $15 mark where we like to buy it. Apple, and by the way, tight stocks below 15. Because once it goes below 15, there's no real support. This green line is 15. It's good support. But silver is a very, 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 very expensive contract, so be very careful with silver. More varies. I should say very much more often than that. All right, what else is happening? Portfolios, right? Yes, we were going to talk about that. So, long-term portfolio up 137%. That's without the adjustments being made. I decided I want to do all these adjustments now. I got a lot of homework. Today and tomorrow, I'd like to try to get all the portfolio reviews done, even though it's a week early, because next week I'll be in California. And I know what a nightmare. I don't have, I need a lot of screens to do a portfolio review, because I'm actually looking at every company and trying to figure out what it's going to do for the next month. So like I said, the start of it though is to say, well, I don't think the market's going to change very much, so therefore we're probably going to be status quo, hopefully on most things. But anyway, like I said, when I'm in California, I only have 2 screens really. My laptop, which is a nice big screen, and another screen on the side, and that's torture for me. compared to my home setup where I have 6 screens. So it's like, so I really need, I'd rather much get it done here before I leave. Otherwise, it'll be a nightmare. So I'll do it, put it up early, and I don't think it's going to matter that much because I don't particularly think the market's going to go very much up or down. So we just did a short-term portfolio review list. We should look at that. We did a butterfly portfolio review. Let's take a look at the reviews we did today. And yeah, let's not forget that the beige book is in 10 minutes. So what else do we talk about today? What was this about? Oh yeah, these that's these same support resistance lines, right? So they're like so squeezed from the recent action that it's so weird. You can barely see the line in between where it's actually going. All right, so here we are on the butterfly portfolio. So as of before the market fell further, at 11 o'clock we were at 151,344, and now we are at what? Where are we? 150. All right, so we lost about $1,000 since. Not a big deal. All right, so I moved up and down 1,000. No changes though. Well, we are making changes. They're just not logged in yet to the portfolio. So I said that we're up from our we're up $11,000 from our 213 review, which is fantastic. I mean, it's only a $100,000 portfolio that we're trying to make 40% on. So 11, it's ridiculous to make that much in a month. I mean, that just means everything's going exactly the way we planned it, basically. And some months you get lucky, and some months you don't. But the point is, it's a system where generally we can pretty much count on making around 20 to 40%, usually closer to 40. But I hate to say that without saying 20, because I'm perfectly happy with 20. So if I get defensive, I'll go right back to just shooting for 20. So we got, other than when we got burned in December, we've been pretty steadily gaining 10% a quarter as we planned. And this portfolio is by far the most consistent portfolio we run. For Apple, there's no, we didn't touch it. It is what it is. And all it is a bullish play on Apple. We sold the June puts, not the calls, we sold June puts because we thought Apple was stupidly low. So we said, oh, if somebody's going to pay us $31.50 for the June 175 puts, I'm going to sell that guy saying June 75 puts. That was our decision here. We also sold the April calls, 5 of those. So we sold 10 of the June puts and 5 of the April calls. That's much more bullish. And we have the 122.10 spread, $15.90 spread. That's a lot of money. I forget how much money, but it's a lot of money. 135,000. There you go. Quite a lot of money for one position. But again, it's a big position in a portfolio, but if Shaquille O'Neal is playing your grandmother in basketball, and that's one game, and then you've got other games that are more evenly matched that you can't for sure be assured of the outcome. When you put the most of your money on betting on Shaquille O'Neal beating your grandmother, it just and that's what it is. I mean, this is the best stock in the portfolio. It's the best stock in the world, and I know it doesn't look like it right now. It's been getting mistreated, but still. And I just said this to Doug, who runs our hedge fund, because he said you want to cover Apple at 175. I'm like, I'm not covering Apple at 175 when that's and we quarter covered it. I mean, we did not cover it, but I mean, I didn't want to be doing any big hit covers because I said, look, it's 175. It's $820 billion. They've got $250 billion in cash, and they made $60 billion last year. So even if they were $900 billion, I'd still pay that for somebody making $60 billion, but they're not. They're 823 and they have cash. Although you can't make heads or tails out of this stuff, but they do in some the long-term investments and all this crap. They've got they've got a lot of cash. They've got 250 billion at the last count in cash, and some of it's still overseas and so on and so forth. But this company is worth a lot more than the net of 823 minus cash. So let's say it's even 600. So you're paying 10 times earnings, less the cash. For the company that's ubiquitous everywhere. I mean, everybody's got iWatches now. Everybody's got everybody's got an iPhone, of course. Everybody's got an iWatch. That's starting to catch on really well. Their wearable segment made them, has been growing the fastest for them. They are the #1 watch company in the world now. They're the #1 wearable company in the world. And everybody says, oh, well, they're one, what do they do? What have they done? They came out with watches. I think it's amazing to me that people say, well, what's Apple done lately? They just have the phone and the phone's going to cycle out and whatever. It's like, yeah, they know that. That's why they came out with watches. And they're going to come out with glasses. And they're going to come out with VR sets. And they're going to come out with other stuff. They're coming out with home stuff. They will come out with more stuff. And people still need phones. Doesn't mean people don't need phones. They keep buying them over and over again, these phones. It's not a fad. Yeah, I mean, yeah, it won't grow as much, but they still have phones and they still use phones. So they'll sell more every quarter. They're just not drastically increasing their market share. But they know that, and that's why they shifted to the watches. Anyway, so I don't mind a company like that being a larger part of the portfolio. But this particular trade, we're looking at the potential to make $90,000 if Apple gets to 210. And that's June 2021. That's far out. It's not even January 21. It's June 2021. So we have a long, long time to wait. Disney, again, to me, a bulletproof company that you want to make a large part of your portfolio. They've got Captain Marvel on Friday coming out. It's going to be the biggest movie of the weekend. We'll see just how big it is. But so far, what I've heard is it's going to be possibly their largest origin movie ever, which means, like, in other words, like Iron Man 1, Spider-Man 1, the first one of each one, they don't do as well as the sequels. The sequels actually tend to do better because people are excited about the sequel coming out because they've seen the character before. Nobody actually knows. You have to understand, nobody really knows who Captain Marvel is. She's a minor character from comics. So if they pull this off and they develop another hero like Guardians of the Galaxy, they develop another hero like Guardians of the Galaxy, which is a $1 billion franchise now, and Disney just creates another $1 billion franchise. Like, what else would you like them to do in a year? And then they'll say, oh, yeah, we're also putting out another Star Wars in December, and we're also putting out Dumbo, the live-action Dumbo, and they're also putting, I mean, they got Blockbuster, and the next Avengers movie is this summer. So Disney is dropping hit after hit after hit all year long as far as the movies go. The chance of any of those movies failing is incredibly slim. And then as soon as this year ends, they're going to start talking about opening up the Star Wars theme park and hotel. Okay, they're building a gigantic expansion to the Magic Kingdom in Orlando and the Los Angeles park. And it's a Star Wars themey thing, and in both of them they have hotels. The Star Wars hotel is going to be an experience hotel. You stay at the hotel, and you are effectively in the Star Wars universe in a hotel, staying, with all the characters and everything else running around, which is going to be, weird and crazy. I used to go to in Orlando. My favorite thing in Disney, though, used to be in the downtown Disney, not in the parks, but in the they had an area, bars and restaurants called downtown Disney, and there was a thing called the Adventurers Club, and that was it wasn't a restaurant, sorry, it was a bar. It's a bar, and you would go to the bar, and everybody, not everybody, in every room of the bar, there was animated things, like talking things on the walls and pictures that talked and crystal balls that talked to you and things like that. But there was also actors playing parts of like an old African safari club. And I used to love it. My kids used to love it. I was ashamed when they closed it. It was so much fun. So I think the Star Wars Hotel will be kind of like that. There'll just be these characters around, but they interact with you directly while you're there, which is kind of cool. And of course, unfortunately, I think the worst thing about the Star Wars Hotel is going to be all the people who like overdo it. Like when you go to Harry Potter, you see all these people who are dressed like wizards and all that, and it's a little, it's a little much if I'm in the hotel and people are walking around dressed like Star Wars people. But what can you do? It looks like Comic-Con basically. But nonetheless, that being said, you are not going to be able to get a room in the Star Wars Hotel for probably 2 or 3 years. So you're not. It's failure is not. It's not that failure is not an option. Failure is not a possibility. It's going to take them years. Even if the thing isn't good, it's going to take them years before that hotel is not sold out at full price. Imagine how many people want to stay in a Star Wars hotel. And of course, it's not just that though, because if you're going to the Star Wars hotel, it means you're going to Disney. You might, and you've got all these people who are Star Wars fans. This is why they bought Star Wars. This is why they bought Lucasfilm. You have all these people who may not necessarily be huge on Disney, but they're huge on Star Wars, and they're certainly going to go to see the Star Wars stuff. And while they're at the Star Wars stuff, they're like, I guess we're going to go to Disney again because it's right there. You're going to stay at Disney, you're staying at the hotel, you're in the grounds, you're going to buy tickets for the park, you're going to spend all that money too. Then you've got the Marvel stuff, and then the same logic for Marvel. They're pulling in a next generation of audience. So they pull in the Star Wars fans, they pull in the Marvel and superhero fans. That's worked out much better than they thought because Disney is just, obviously Marvel was doing some stuff with movies that was so before Disney bought them. They've now turned it into like blockbuster after blockbuster after blockbuster. So again, how could you not want this company for the long term? So that's the bottom line. And again, we have a bullish position on Disney, and that's why. That's my summary of why we have a bullish position on Disney. Mondelez, we are not bullish. And somebody said they thought this spread was wrong, but it's not wrong. The thing is that the butterfly portfolio has ended up having ended up having plays that we were just bullish on, whereas usually a real butterfly play looks like this. We buy an outside call, Mondelez at 45. We buy the $55 call, so it's only $1.75. We bought the $38 put because that was only $2 at the time. And we buy them to protect ourselves in case the 45 and 42 puts and calls that we sell, in case Mondelez jumps up 10 bucks, we're protected. It's not likely to happen, but it could easily go up 10%. That's $5. So we want to have a cap on our losses. So this caps our losses. Meanwhile, though, the net of this spread, and I wrote that somewhere under the Mondelez, there. So I said it's all, okay, so the action, we sold $26.50 of puts and calls against $7,500 worth of longs. And that means we're into net, why did it say 7,500? I did that math wrong, I think. Yeah, it's 7,500 minus, well, okay, it doesn't matter how you say it. All right, so 7,500, and against 7,500, the first sale we made, all did this at the same time. So we have 7,500 of longs, and we sold 2,600, 1/3 of that in 1 quarter. We have 8 quarters to sell. In 1 quarter, we sold 1/3. That means in 8 quarters, we'll sell 8/3, and 8/3 is 2 2/3. Okay, so in other words, if we sell 2 2/3 worth of more than we paid over 8 quarters, that means we'll profit by 1 2/3, 166% profit. That's how that works. So we're in a great position. We sold the 45 calls, we sold the 42 puts. It doesn't matter if Mondelez finishes a bit higher than 45. All we're going to do is roll it to June. It doesn't matter a little because we'd rather collect the 175. But if it doesn't, we'll roll to June and we'll collect it then. But that means that instead of collecting 8/3, we'll collect 7/3 because one's going to be a wash. But you keep widening the spread, whichever the losing side is. We widen the spread until we hit it on the nose. Every time we hit it on the nose, we collect the full amount. Boom. Money in pocket. And notice we only sold half the call, so we have room to roll and do all sorts of things at this stage. And that's what a real butterfly play is. This is the only, in the butterfly portfolio, really this and Whirlpool are the only actual butterfly plays. The other ones are bullish positions that we took on these stocks. We didn't start out that way. We started out with more of a pure butterfly play, but as things develop, when the stock changes, if it suddenly goes low in the channel, if it becomes cheap, which has happened to Apple and Disney, we say, well, screw that then. We're gonna change our position. I don't have to slavishly stick to the format of the butterfly just because it's in the butterfly portfolio. The opportunity is there. You take the opportunity. Oh, the Beige Book is out, isn't it? Okay. All right, let's go look at that then. Let's get off this. Beige Book, Beige Book. FOMC, Beige Book. It's not as fun. It's not as much fun to read as it used to be. March. This is March, right? They really messed up the format. The format used to talk about each. They used to talk about employment, wages, prices, and so on and so forth across all their sectors. They don't really do that as much anymore. So it's really kind of not fun to read. But let's just take a look at what they're kind of saying. Okay, economic activity continued to expand in February and January, 10 districts, slight to moderate growth. That's interesting considering that was during the shutdown. Philadelphia and St. Louis flat. About half the districts noted the government shutdown led to slower economic activity in some sectors, including including retail, auto sales, tourism, real estate, restaurants, manufacturing, and staffing. Just some sectors. Consumer spending was mixed across the country. Low retail sales and auto sales to higher cost of credit, manufacturing, which was caused by the Fed. And again, this was what I was saying during the winter when this was happening. I was like, these are self-inflicted wounds that we can quickly heal from because we caused it all. The Fed tightened, the government shut down, people are freaking out. We started a trade war with China. All these things are things that we did. We're not helpless victims here of some economic cycle. We made all this happen. So it's easy enough to make it unhappen, which is what really has been happening lately. You know, the Fed reversed course on their tightening, and everything else started falling into place. And we're making things with China and so on and so forth. So it was easy to fix, and now we're back to almost where we were. You know, getting back towards the highs. But again, above here, why? Why would we go higher? What has improved? All we've done is take away the detriments. But that's not the same thing as making actual improvements. This is impressive, though. I think saying if you had slight to moderate growth in all 10 districts, or in 10 of 13 districts, and flat in the other 2, this is not bad because we had a government shutdown. I mean, this you would think is a worst case scenario. Manufacturing activity strengthened on balance. Numerous manufacturing contracts conveyed concerns about weakening global demand. Higher cost due to tariffs. Again, we did that we did it to ourselves. Trade policy uncertainty did it to ourselves. Activity non-financials increased at modest to moderate in districts driven by professional blah, blah, blah. Residential construction was slightly higher. Home sales were lower. That's still going on. Several real estate contacts noted the inventories have risen slightly but remain historically low. Home prices continue to appreciate but at a slightly slower pace, and agricultural conditions remain weak. Home prices, by the way, rose about 5% last year across the board. Vegas was the hot spot. They had an 11% rise. Places like New York City had a 3% rise. San Francisco, 3%. So the places that were really high rose 3%. But basically, everybody rose. There's almost nowhere in the country where the real estate prices didn't go up, and the average was very close to 5% for everybody. So I mean, that's not bad. You know, if you've got a house that makes 5%, that's good. Employment increased in most districts, modest to moderate gains in the majority of districts, steady to higher employment in the rest. Labor markets remain tight for all skill levels, including notable worker shortages. We know that. Wages are kicking up. That's why Friday we're going to be very concerned about the wages in the non-farm payroll report. Context in the higher education from St. Louis, namely because falling enrollment as potential students were increasingly choosing to enter the labor market. Oh, that's interesting. Also, obviously, we're not letting immigrants in. So, you know, if you're not letting anybody in, they can't go to college in America. So that means we're killing the demand that used to be there from foreign students. And believe me, America looks a lot less attractive to foreign students. You know, one of the reasons you go to college in America is you hope to establish residency and get a visa and be able to work in America. That's why people would spend the big bucks to go to college in America, even though it's free in their own country. So why are they doing that? They want to change their lives. They want to move and be part of this country. We put up a big "You're not welcome" sign, and that's not happening now. So it is going to be a problem for colleges. Wages continue to increase for low and high skill positions. Districts higher wages. Context enhanced district rising non-wage forms of compensation. Also, yeah, that's when you really start seeing some creep. Is that bonuses, relocation assistance, vacation time, flexible work. They got to make concessions now to get employees. So that's what happens first. First, you get the non-compensation concessions, and then employees are happier to make them paying more money. The problem with paying more money is if you pay more money to somebody, that immediately causes problems with everybody else you're paying money to. So they prefer to do other things if they can. Prices increase moderate, 7 districts noting faster growth for input prices and selling. They're having trouble passing the price on to consumers. The ability to pass on varied by region. Few districts noted demand and the level of industry competition played a role. A few districts continue to report upward price pressure from tariffs, self-inflicted. Certain goods, however, several districts noted the price of steel, which has been impacted, has stabilized or fallen. Energy costs declined in some areas. Agriculture mixed, although soybean prices were very weak, of course, as we were talking about before. And then they do the district. See, it used to be way, way more in depth on all these things, and they would do the district reports as an afterthought. Now they kind of like you have to read every district report to see how they particularly did on their thing, which I don't like. So basically, though, it's a not very nothing exciting beige book, but it's actually, I think, better than feared. Which means we probably should have stayed with that Russell play, yeah. So better than feared because the government shutdown had very little impact on the whole. Everything else is chugging along, and most of the damage that was done is because we did stupid stuff. And so if we just stop doing stupid stuff, things will get better. That's not complicated. Where are we? Okay. So any questions? Nope, no questions. You guys are amazing. Nobody wants to know anything. All right. Where was I? Butterfly, right? So Mondelez is a proper butterfly. OIH is another one. Now this one's not going well. We make bets. Some of them win, some of them don't win. Apple is up, you know, $30,000, $40,000. Mondelez is at the moment down $7,000. They're not all going to be winners. I like OIH, and we changed it. We what did we do? Okay, we sold some July. Oh, yeah, no, we didn't change anything. We sold some July calls just to make sure we make some money, but we're not very confident where it is. I'm surprised. I don't understand because you've got all these people expanding their drilling. You know, this is what made me want to stick with it though, because Chevron and Exxon, we just looked at that.
just said they're gonna quadruple their amount of output in the shale and stuff. They gotta buy the equipment. That's what OIH is, and the suppliers of all this equipment for the drilling and stuff. It's very odd.
So, not ready to give it up yet, but I'm actually kind of weird that it's not doing much better. Whirlpool, we just added that one because we were looking for, you know, the butterfly portfolio did exactly what we wanted to do last year, made 40%. We only had 5 stocks, did great. We still have 5 stocks, but we changed, I forgot what we changed. We changed something. We still have 5 stocks, but now we added Whirlpool. And the Whirlpool trade is brand new, so you can play it from scratch. It's net $66.69, and has a 23,331 upside, plus whatever we make selling puts and calls, which could be another $20,000. I said that is why this portfolio makes this kind of money. It is insane how much money you can make doing this. What are we doing? On the power options finally did something for me. They finally made it so I can put more than 4 things in a section. It used to be 4, and I had to put, like with Apple and Disney, both of them, they went over 4 at some point, and I had to put these separate. Now I can make now I can do 5. I don't know how many I can do. I can do 5 at least, maybe 6. And I can keep them together. They took away that limit that used to be on it. So anyway, so the key to Whirlpool is we have a 120-150 bull call spread, $30,000 bull call spread. We sold the 145 calls, which is an aggressive, no, I'm sorry. We sold the 125 puts in 2021. I'm sorry, in June, no. In 2021, we sold the 100 puts, which is really wimpy, but look at the money they paid us for it. And it's still crazy high. That's an insane amount of money to get paid for selling those puts, because they're $40 out of the money, and you're selling them for $750 even now. That's crazy. So you're netting it for $92.50. So it has to drop like $50 before you're even a little bit in trouble. So anyway, so the main spread is 120-150 with the short puts. Okay, and that even as it stands, that's 30 minus 16 is 14, I guess. Minus 4 is 10. So it's $10,000 for this $30,000 spread. That's step number 1. Step number 2 is we take these June. Now that means we're selling halves, so we're going to be able to sell 4 halves. But we sell the June puts and calls for $5,000. So like I said, that's another $20,000 we can collect. We can do that 4 times. And this is a pretty wide spread. 145 calls, 125 puts. They have a very high likelihood of success. So in other words, the main spread is 2/3 in the money and can pay up to $30,000 if Whirlpool goes up $10 over the next 2 years. And meanwhile, every half, we're selling $5,000 worth of premium. So that's the $20,000 that we can make on the spread, and another $20,000 we can make selling premium, $40,000 potential on the spread, on a $6,600 spread. $30,000, I mean, well, $23,000, I mean, $33,000 upside potential on the overall spread. That's crazy. That's incredible returns on your money. And it's a very conservative way to play. We're playing the 120, 150 bull call spread. It's been up at 150 already. So we're playing this for our longs, and we're selling in between the 145 calls and the whatever the hell they were, 130 something. What do we sell? The 125 puts, wow, geez. And the 125 puts for June. So in June, if it stays between here and here, both of those expire worthless. We keep $5,000, and our net cost goes down to like $1,600 on the $30,000 spread. And then we sell another $5,000 worth of puts and calls, and we wait until January to see what happens. You don't have to be
into some exciting, crazy trade to make a ton of money. It's like 400, it's like 4 times return on your money. Just doing that. It's not complicated. You can see the channel, the whirlpool's in. And I was betting it stayed. I'm saying when we resolve this trade thing, I think it's going to stay closer to the top of the channel. And that's what we're playing for right now. That's what we're looking at. All right. I think, did I get to the short-term portfolio? I don't remember. No. Oh, man. I thought I got to the short-term portfolio. All right. Short-term portfolio. Dun, 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 dun. So it's long. Here's the money to our portfolio, which we don't touch. That's up 150%. That's crazy. It just keeps making money. Yesterday it was at 145, and I was like, wow, 145. Now it's at 150. It's hard to explain. It's just like sometimes you just pick everything right. You know, it's like you just have a really good portfolio. But, you know, again, my selection process for this portfolio was to, pick stocks that from quarter to quarter I didn't expect to have to touch, because it's for the radio show and I'm on every quarter and we only make adjustments live on the air. With the exception of GE, which I sent out a special tweet to tell everyone to get the hell out. So I did take that one off because I did sell on 125. I forgot I did that, but I sent it to the Money Talk people specifically saying, get the fuck out of the GE play because it was falling apart. I could tell. You know, again, they spun off a division. It's really not as bad as it looks because GE went down. Here's GE. They just warned yesterday they're on profits. So on 225 up here or around here, when it was spiking up, that day when it was spiking up, I said, let's get out. This is a gift, you know, because they were doing their spinoff, and I'm like, this is not a positive. This is going to be, you know, the stock's not going to be what it was. And lo and behold, it takes a while, but they just announced today, 2 weeks later, that you know what, we're not going to make any money this year because you know that spinoff is killing us. Because the spinoff took a lot of the money out of the company, the revenue generating capacity. It's going to be a while before they can apply the cash or their ability to borrow more money to build up the other divisions that they still have left inside the main GE. But it's not as bad as it looks because you do own a certain percentage. If you own these things, you still own a certain percentage of the spinoff company. But on the whole, it wasn't worth the hassle, so we got out. And we'd end up with non-standard options and so on and so forth. But other than that one exception, though, we've never touched anything other than on the show. And these are it's just a beautiful bunch of stuff. Now, Macroeconomic spread was having some trouble, but we're going to stick with them. And I can't do anything about it anyway, even if I do. MJ's a marijuana ETF. That thing's going gangbusters, so I'm not too worried about that. Limited brands had huge troubles. In fact, this is good for a new trade right now. They fell down. IBM is IBM. I think it's my stock of the isn't that my stock of the year? I think it's my stock of the year this year. So IBM is my stock of the year. I'm certainly happy with that. And look how conservative we were, though. We have the 120, 135 spread. Another one's good for a new trade. We have the 125, 135 spread. It's a 137. And it's a small spread. We did a very wimpy amount here for some reason. It's currently valued 9, 10. It's valued. It's $1,500 total, right? The sum of those numbers is $1,500. But the spread itself is 15 times 5 is $7,500. So it's $1,500 net cost on a $7,500 spread. And I still don't know why I took such a small amount. That's weird, but we took a very small amount. And so 1,500 turns into 7,500 if they hold 135. That's all they have to do. It's not that hard to make these kind of setups. You know, we make like a huge return on cash.
I guess that was the point I was trying to make at the time, but I still can't, not sure why I did such a small amount. We have cash, right? We have $76,000 cash, so we need to do it. Then we have gold, which is the new ABX. Now, ABX combined with gold, which is Rheingold, and made a much bigger company. Now they want to buy Newmont too, which is a huge manufacturer, another huge gold company. If they do that, they'll be by far the largest company, the largest miner on the planet. So it was very interesting. I don't like it. I wish they would just, work on the one acquisition they have. But I think that the AB, like so-called ABX, but they're not. I think Barrick, the so-called Barrick, I think Barrick believes that gold prices are going to go flying up in the next year or two, and they are trying to acquire as much as they possibly can while the prices are still down and while the market's still depressed. Then we have GIS. I think that's a no-brainer. That's an easy one. And Caterpillar always comes back, so we're not worried about them either. And again, another very conservative. We have the 100-130 spread. They're at 135 already. We have 2 years before we make our money. Currently, it's 20 minus 11 is a 9, minus 3 is 6. So it's $6,000, and the spread is $15,000. So all Caterpillar has to do is stay where it is, and you make on $6,000, you make $10,000 more dollars. You make $9,000 more dollars. It doesn't get simpler than that. And our hedges, fortunately, haven't suffered too much damage. That detracts from it, obviously. But these hedges save our ass if the market goes down. That brings us to the short-term portfolio. Now, last time, I'm finishing here, so if you have any questions, ask them now, because I'm out. That brings us to short-term portfolio. We're not that heavily hedged. You used to see us when we're heavily hedged. Because we've made so much money in the long-term portfolio, we have taken, some pretty big positions. We have 200 SQQ January 10s. We have 200 TZA a year later. The 2021 $7 calls, and that's a balance though because we sold the 2021 SQQs here. I don't want to get into it, it's too complicated now. But we have a lot of hedges. We have 400 in the money calls on TZA and SQQQ, and so any kind of pop in the market is going to give us, well, they're both close enough to 10. So if you say at 10, a 10% drop is a 30% pop. So let's say we get about a $3 move from these guys. That's $3 times 400 times 400 contracts is, I believe, it's $120,000. So yeah. So in other words, if on a 10% drop in the market, we're going to pick up $120,000 to compensate us against our long-term portfolio. So basically, the long-term portfolio will get paid back 10% of what its total balance is. It's about about 1.2 million. So the long-term portfolio will get back 10% of what it loses of its total balance. So now the long-term portfolio is leveraged. It'll probably lose 20%, but that's fine. I don't mind if a 10% drop in the market only hits us to 10% of our portfolio. We keep most of the gains, and this thing goes from 739 to 850 or 900. And so we have $1 million in a portfolio that only had 100,000 when it started last year. $1 million is more than the long-term portfolio and short-term portfolio combined last year. We only started with 500,000 long-term and 100,000 in the short-term. So if I have $1 million in the short-term portfolio, I can't be losing, and I will still have almost $1 million in the long-term portfolio. So what we're doing is locking in our gains. When you make ridiculous amounts of money like that, you've got to lock in your gains. And that's what these are for. And we added this TNA spread also. This is a bearish bet on TNA. We bought the $55 puts, sold the $35 puts. TNA is quite a bit above that, and it's lower now than it was. TNA. So in other words, instead of buying more TZAs, I said, you know what, TNA is going to decay anyway. And this was back in the middle of February when we did our adjustment. So I said, I want to do TNA. Instead of buying more TZA, I said, let's short the opposite one, which is TNA, because it's not going to likely be supported up here. And lo and behold, boom. So should the Russell fall significantly, and it's coming down hard today, but should the Russell fall significantly, TNA will quickly go well below 50, and we will be able to cash in this one. This one's more of a fun one that we'll cash in more quickly. But if we get down to 35, it's going to pay $100,000, and we only spend $20,000 on the spread. It's already up. What, like $2,000? So it's already up $2,000, but it has the potential to make $80,000. So that's a nice little hedge that we added. And what do we spend? We spent $20,000. We can't possibly lose more than $20,000. That is nothing compared to the gains in the long-term portfolio. But we hedged. So the long-term portfolio made $100,000 in a month, and we took 20,000 of the 100,000 that's still on paper. It's only a virtual gain. We didn't cash it yet, but we took 20,000 of that implied gain and used it to buy an $80,000 hedge. So now if it goes the other way, and you can see that on TNA, because it was down here. So when we looked again, so here was at 50, it went up to 70. And so we say, well, gee, then it could easily go back to 50. If it goes back to 50, I want to have this hedge. And so we bought the 55.35 put. Now at 50, it's not going to pay much, but the point is that we're covered. And if it's a worse sell-off than that, if it goes lower than it went, then TNA is going to quickly go down to 35. And then we have $100,000 towards the loss of the long-term portfolio. So this portfolio, counting that one, is good for, what did I say before? 400 times 3, 120. So it's good for about $200,000 to offset a drop if we have a 10% plus correction. And again, that's, the whole point of portfolio management is you have to know how much you're going to make, like in the OOP, right? When I do a full review, which honestly takes so long, I don't often do it. But when I do a full review, I say, look, this is a $90,000 upside potential. This one's a $18,000 upside potential. I know. And I think it was 140 something. Yeah, I know that these trades are going to make $140,000 if the market stays well. Now, obviously, any individual one could go the wrong way or whatever. But the point being, given, unless something weird happens to one of these stocks, if the market goes up and they all go up with the market, they're going to make $140,000 in profit. I know that. And if I know that, and I know that's like miles more than we need to make to hit our goals, because our goal is to make $40,000 a year. I know I have tons of room to play. What's going to hurt me is down market, so then I hedge. I know what I'm going to make, and I know the only way I won't make it, and again, outside of an individual stock having some issue, but the only way I'm not going to make it is if the market crashes. And if the market crashes, I have a pretty good idea of how much money I stand to lose. Therefore, I hedge, and I hedge not all of it, because if you hedge all of it, you spend too much money on your hedges. I generally try to hedge to mitigate about half the losses on the way down. And that's what we're doing there in the short-term portfolio. All right, and the short-term portfolio protects the long-term portfolio, not the butterfly portfolio. The butterfly portfolio, honestly, it doesn't really need protection, because we do sell calls, we sell puts, we sell calls, but eventually things cycle back and everything's fine. So not really an issue. And what happens is, because that did happen during the year, if we get crushed to the downside, we end up turning it into a bullish spread. If we say, oh, well, you know what, we're not going to do a butterfly anymore, we're going to do a bullish spread. And then that bullish spread then turns, if we cycle back, which, you know, generally we do in the 100-year history of the market, we generally cycle back at some point. In this case, we cycle back very quickly, and our two big losers have turned into very big winners. And that's why we're exceeding our goal by a pretty big margin at the moment. All right, I don't see any additional questions. The Dow is down 120 points again, so that little pop was not a big deal. See, it quickly faded out, but it would have been nice if we played it. I don't see anything exciting here. We don't, you know, there's nothing too exciting about the oil thing. Gasoline is a good short here, actually. 180 would have been a great short. If I was going to play, I would short gasoline here, 178.5, and keep that as a very tight stop, 178.5. But there's nothing bullish about gasoline in this report because we know, which the average trader doesn't pay attention to. We know the only reason there was a draw on gasoline is because we shipped out 21 million barrels of it overseas. That's the only reason. And gasoline's miles ahead of oil. The demand picture isn't there for it. There's nothing to justify it. It's going to go lower in the short run. In the long run, it's going to go up for the holidays. In the short run, there's not a good catalyst during the month of March to move gasoline higher until Easter. Before Easter, you got to get out and start going long again because that's another holiday weekend that you got to watch out for. Is Easter now? Wait, when is Easter? Huh, maybe maybe it's important. When is Easter? I know my daughter's on spring break. Oh no, April 20. I don't know what break my daughter has then. My daughter's off next week. I don't know. Maybe she's lying. Maybe she's maybe she's skipping college. Anyway, she's off next week. So April 21st. So we have a long time before there's any major catalyst that's likely to take things higher, and that means it's a great time to take that short. But again, tight stops. So 170, it's at 1784. You want 1785 to be your stop. You short gasoline, and hopefully pick up a couple of pennies. It's $420 per penny per contract. You don't need a big move, right? And you see the market weakening, and you see the oil's weakening, and Brent's weakening, and gold is not strong. Nothing's strong. There's no reason, and the dollar's still up here. There's nothing really to support that run that we had today, based on the report. So if it goes back here, it's 2 cents down, $800 profit. Who doesn't want that? I like that. So we'll see how that does next week, and I'll tell you what, I'll put it in. All right, let's put it in. It's just so we remember to keep track of it. Now, I'm going to take 2 cents and run. I'm warning you right now. Can I get that? Ugh. Can't get a fill. Dun, 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 dun. Oh, got it. Haha. See? Don't be too quick to move your thing. All right, so I got one contract. We'll just see how that plays out for a while. Again, stop at 1785 right there is the stop. You don't put it in though. If you put it in, it's going to flush one way or the other. But if you see it trending up that way, you want to get out and be thrilled if you make $500. I mean, frankly, be thrilled if you make $100, right? Like we said, if you make $100 real fast, take it. But I'm hoping to at least get back to this 177 line. That's going to make about $300, $250, $300 at least. So I think that would be my realistic target. All right, well, hopefully that works out. And if it doesn't, we'll talk about it next week. And if it does, we'll talk about it next week. Uh-oh, wait, nah. Somebody at the last second, really, Rob? I have a lot of retail stocks like LB, BBY, in my portfolio. What would you recommend to hedge these stocks? Well, I mean, if you want to particularly hedge them, I would hedge it with the retail ETF, which is XRT. Hang on, now I don't have time for this. Why did you not ask this question like an hour ago? XRT is at 45, which is not very good. We shorted XRT early in the year. Well, yeah, I guess if you're really worried about it, you could set up a spread on XRT because it's not that low, and you're worried about staving off some serious damage. I would go for like a January spread, and I would try to keep it where we are. It's not that expensive. See, it's pretty reasonable because you can take the XRT that you can buy the 45 puts, sell the 40 puts, so that's 140, and the 45 puts a 3. Let's see if we can do better if we went higher. These are 450, and the 43s are 230, so that would be 220. No, I would really keep it because I'd want to keep it cheaper. So I think I would go with the 45 call buy the 45 puts for like it's $3 somebody just bought them for. So if you can buy those for 3 and you can sell these guys for the 40 puts for 150, that puts you in a net $1.50. All right, so you're going to lose that $1.50. Keep that in mind. You're going to lose the $1.50 if retail does well. It's gone. And that's going to be how much money you're willing to lose if your other bets do well. So you take a portion of what you expect to gain and say, this is how much I'm going to take out of that to hopefully prevent myself from taking a big loss. Then you mitigate that. So let's say you take about 25% of what you think you're going to gain, and you buy this spread. Now, what happens if this spread pays off in full? Then you're going to get back $3.50 on your $1.50, which is 200% back. So if you had if you expect to gain $100,000 on your longs, you take $25,000 of what you expect to gain, $25,000, you put it into this spread, and then if it all goes to hell and you lose money on your longs instead, you'll collect back $75,000 on this spread, basically. So you get $50,000 of the money you lose back. So that's the way you want to sort of manage a hedge to offset it. You're not going to get the whole thing back. You're not going to completely offset all damages. Otherwise, you spend too much on the spread. But you're going to take 25% of what you would have, of what you hope to win, and you put that into the spread to protect yourself and mitigate the damages on the way down. So that's pretty much how I would handle that. All right. So hopefully that was clear enough. And if not, you can ask me in chat, and I can draw it out for you. All right, but thanks a lot for coming, everybody. And we will not do it next week. I will be in California next week, so no webinar. Way too exhausting. But when I get back, we will do it again. So a week from next Wednesday, we will have another webinar. All right, thanks, guys. Take care.